Welcome to PIMCO Pod. In this episode, we discuss how structural pressures from the AI buildout are real, but they are growing slowly, not driving the yield moves investors are watching right now. Stay tuned after the conclusion of the podcast for additional important information. AI financing needs do not override cyclical drivers of yield by Lotfi Karui. AI is a transformative technology with both near-term and long-term implications for the economy. For investors, while the debt-funded AI build-out has the potential to become a secular driver of risk premia, we believe any such shift would only play out through a multi-year adjustment and would not override the cyclical forces that affect markets. For that reason, the idea that the year-to-date surge in AI-related debt issuance has been a contributor to the recent rise in long-dated U.S. Treasury yields appears overstated. Instead, the move seems driven primarily by shifting policy expectations and a repricing of the Federal Reserve's expected rate path, not by a meaningful rise in AI-induced term premium or related indigestion about duration, interest rate risk. A simple decomposition of the 10-year U.S. Treasury yield move since the start of the Iran conflict makes the point. Most of the increase has come from the rate expectations component rather than the term premium. Since February 27th, the last business day prior to the conflict, 10-year Treasury yields have risen by roughly 51 basis points, BPS, of which 38 basis points reflects shifting rate expectations and just 13 basis points a higher term premium. Just as important, the duration supply shock has not fully arrived. Measures such as the average duration of the Bloomberg U.S. Aggregate and Bloomberg U.S. Corporate Investment Grade indices remain well below their post-COVID peaks, suggesting the market has not yet had to absorb the full, long-duration footprint that a sustained, debt-funded AI CapEx cycle could eventually create. That risk is real, but it is more likely to build as a slow-moving structural pressure than to explain the recent move in yields. Distinguishing cyclical market behavior from longer-run concerns. By the same token, AI-related credit expansion, wider fiscal deficits, and persistent external imbalances do not mean that U.S. Treasuries have lost their hedging role in multi-asset portfolios. While the current fiscal math in a recession scenario is not particularly comforting, cyclical market behavior should be distinguished from longer-run concerns. The two can coexist. Questions about fiscal sustainability may persist, but that does not prevent yields from falling when growth contracts or slows sharply. Further, most recessions entail negative demand shocks that widen the output gap and are therefore disinflationary, a positive for duration. Tactically, the recent reset higher in bond yields is also doing part of the work for investors. Starting yields are materially higher across core fixed income markets, lifting the forward total return profile. If growth does slow or policy expectations reprice lower, that higher starting yield can provide both a cushion and upside optionality. In other words, the setup for fixed income total returns has become more supportive rather than less. The credit story: hyperscaler curves steepen, others flatten. In credit markets, a clear bifurcation has emerged between hyperscaler long-end spread curves and the rest of the non-financial universe. Hyperscalers are the few largest companies providing the cloud computing services that underpin AI, data storage, networking, processing, and other computing. Non-financial 10s/30s spread curves have been largely well-behaved, flattening since their local peak at the onset of the Iran conflict at the end of February. The hyperscalers tell the opposite story, with volatile or steepening curves. For the broader market, the elevated absolute level of U.S. Treasury yields continues to draw all-in yield buyers into long-dated corporate credit. But there is also a technical tailwind. After stripping out hyperscaler issuance, the gross supply share of U.S. dollar-denominated USD 30-year investment grade IG credit is running at its lowest rate in several years, under 10% of overall supply by our calculations. Hyperscalers, by contrast, have shown a strong preference to lock in yields at much longer maturities. While hyperscalers accounted for 13% of year-to-date 10-year supply, approximately $21 billion, they constitute more than 30% of 30-year issuance, approximately $32 billion. And this isn't just a phenomenon for USD-denominated debt, it's been a multi-currency affair. The bond markets denominated in Euro, EUR, British Pound Sterling, GBP, Canadian Dollars, CAD, Japanese Yen, JPY, and Swiss francs, CHF, have all seen hyperscaler issuance at the 25-plus year part of the curve. Alphabet even issued a century bond in GBP in February. While some of these markets are accustomed to longer-dated bonds, for EUR and CHF investors in particular, these maturities are unusual for corporate issuers. We believe they largely reflect a need to diversify across currency benchmarks to mitigate ticker concentration risk within investor portfolios. The takeaway is straightforward. The steepening in hyperscalers' long-end slopes is a direct reflection of investors demanding more risk premium, exactly where issuance has been heaviest. Thank you for listening. That was AI Financing Needs Do Not Override Cyclical Drivers of Yield. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.